It looks like our YouTube channel is on.
I'm going to start the recording of the meeting.
Okay, we're ready to start. Call to order the board meeting for the Texas Emergency Service Retirement System. It is May the 20th, 2021. It's 9:01 a.m. Shayna, can you call roll?
Laura Rodriguez,
Here.
Courtney Bechtel,
Here.
Nathan Douglas,
Here.
Matt Glaves,
Here.
Ed Keenan,
Here.
Jerry Romero,
Here.
Rodney Riles,
Here.
Steph Wagner,
Here.
Vice Chair Rodriguez, 8 board members are present and 1 is absent.
Okay.
Oh, Jenny Moore, I'm sorry, Jenny Moore. Vice Chair Rodriguez, 8 board members are present and 1 is absent.
Okay, thank you, Shayna. We'll move on to item number 2, invitation for public comment. Do we have any public comment?
No, sir.
Okay, so moving on to item number 3, minutes of the board meeting for May 13th, 2021. Is there a motion to approve?
I'll motion to approve. This is Courtney.
Okay, motion by Courtney. Is there a second?
I'll second that.
Is that Ed?
Yes.
Okay, motion by Courtney, second by Ed. Any discussion? If not, all those in favor signify by aye. Or we're going to take a, I'm sorry, Shayna, you're going to take a roll.
If you are in favor of the motion, say aye. If you're opposed, say nay. Courtney Bechtel,
Aye.
Nathan Douglas,
Aye.
Matt Glaves,
Aye.
Ed Keenan,
Aye.
Jerry Romero.
Aye.
Rod Riles,
Aye.
Steph Wagner.
Aye.
Vice Chair Rodriguez, 7 board members are in favor of the motion and 0 are opposed.
Okay, motion carries. Item number 4, investment consultant report. John, you're up. I think you're still muted, John.
Sorry, got it. Okay, so hopefully everyone can see my screen that I've got pulled up here. Let's see here. So let me move forward to our quarterly report. So what I was going to do is kind of move through the economic review fairly quickly, and then touch on the performance. I know you guys have a couple other things on the agenda today. I'm not sure how much time those are going to take. So I'll kind of move through things, kind of focusing on the highlights, and then you guys can fill in certainly with any questions. I will say that we had a pretty robust discussion at the investment committee level on Tuesday of this week. Got some good questions there on some of our managers. And then after an update in April, what we're also going to touch on is some potential rebalancing in the portfolio, just kind of reflective of the fact that we have enjoyed such a good run in the equity markets here, really over the last kind of, I guess, 15 months at this point. So on page 2 here, when we summarize the quarterly performance, you know, what I think really stands out is this top right chart of just kind of how powerful this equity rally has continued to be. You know, we saw kind of the rally really take off in kind of November of 2020. That was when we got the news about the 2 vaccines being approved. And really what we've seen is kind of this follow on based upon an assumption that, you know, we're going to kind of get some level of return to normalcy, you know, kind of starting to see markets and economies reopen. Certainly, we've been a little bit ahead of that curve in the United States. Europe has been a little bit slower, probably around 6 months behind us. But that should ultimately end up being a bit of a tailwind to economic growth, especially in our international equity portfolios as we move through the remainder of this year. But as is pretty typical in a situation where you're kind of coming out of a recessionary period, what typically leads coming out of those periods are smaller cap stocks in the US, more cyclically oriented sectors of the market. When I talk about cyclically oriented sectors of the market, I'm talking about areas like financial services, energy, industrials, materials, a lot of these being tied to commodities. That shouldn't be surprising because, again, as economic growth starts ramping up, You really see more, kind of whether it's development or business spending, all that really accrues to these more cyclical sectors versus what we saw really dominating markets in 2020, which were really the kind of the growth areas of the market, consumer discretionary, healthcare, technology. These are areas that tend to kind of generate their own organic growth as opposed to kind of being as reliant on economic growth. So all that to say, what you see here in the middle, within the U.S., you see small caps up 12.7%, roughly double the return of the large cap benchmark, the Russell 1000. If we had Russell, the micro cap index on here, that index was up even higher, up over 20% during the first quarter. So again, pretty similar to the standard playbook that you see for an economy coming out of a recession in the U.S. Internationally, we did see some gains, and as we'll see, these were really reduced by a rising dollar during the quarter. And one of the big things that impacted the rising dollar manifests itself in these fixed income returns, which were down pretty significantly in the first quarter this year. You see the Barclays aggregate down about 3.4%. This was, I believe, if I'm not mistaken, the worst return for the Barclays aggregate on a quarterly basis since about 1981. And this was really born out of the fact that we saw the 10-year Treasury bottom out in terms of its yield in August of last year at right around 50 basis points. That Treasury yield climbed all the way up to about 1.75% in the first quarter of 2021. And a lot of this is based on increasing expectations for inflation. We've started to see that come through. We saw a relatively high inflation number printed in April of 2021. And as is typically the case, the Fed has control of that shorter end of the yield curve, kind of those overnight lending rates and very short-term rates. But the bond market controls the long end of the yield curve. And when the bond market sees inflation, its expectation is that the Fed will have to act to increase interest rates. And that's really what we saw manifest itself in the first quarter of this year. Not surprisingly, in an environment where inflation's a little bit higher, we saw the TIPS market, or Treasury inflation protected securities, do a little bit better, only down about 1.5%. And then mortgage-backed securities, which oftentimes can have a floating rate feature associated with them, also held up a little bit better than the more interest rate sensitive areas of government bonds and investment grade bonds. One thing that's been really remarkable, and it kind of shows the power of dropping off a very difficult quarter and adding a great quarter of performance, is these one-year numbers. And we'll see this when we look at the one-year return for the overall portfolio. But you're now seeing returns, in small caps up 95%, large caps up 60%, in emerging markets up 60%. A lot of these numbers, if you think back to the last, big market sell-off that we had, back in 2008, most of these markets, it took 2 years to produce this return that we've seen really in the last 12 months. So obviously this is really reflective of, one, how deep and sharp the recessionary period was, but then also just how much stimulus has been thrown at it, from the Federal Reserve's accommodative stance to the direct payments that have come from the government. Those have really all been the impetus that has sparked this substantial recovery that we've seen really across stock markets. And then, not surprisingly, in an environment that's so good for stocks, we've largely seen kind of the bond market stay flat. And what that's meant is good recovery in corporate bonds, offset by declines in the government sector, again, because of the fact that we've seen interest rates really rising over this 12-month period. The one thing I would just point out on page 3, we've talked a lot over the last few years about kind of the outperformance of growth relative to value. We do our best to try and maintain a balance between those styles within our U.S. and our international portfolios. And we're starting to see the reward for kind of maintaining that balance the second half of last year and into this year, which is that we've now kind of seen value string together a couple quarters of strong performance. That has actually now brought value in line to even ahead in some instances of some of these growth benchmarks over the last year. If you think back to this one-year chart at 12/31/2020, growth by and large was leading almost universally by about 30%. So really remarkable, again, dropping off that first quarter of last year, which was great for growth, terrible for value. and then picking up this first quarter. And when I'm talking about these value sectors, you really see this on page 4. Areas of the large cap market like energy up 30%, financials up 16, industrials and materials up about 10. And then you contrast that with consumer stocks up 3, healthcare up 3, technology up 1. So we've certainly seen a bit of this handoff from these areas that had just been relentlessly dominating the performance of markets towards kind of these cyclical areas. It can get even more pronounced when you look at the Russell 2000. You see again, areas like energy, financials doing well. I would caveat this consumer discretionary because there were a couple stocks that really drove this performance within the U.S. small cap market, and those are kind of shown on page 5. And these, if you read the Wall Street Journal or you watch CNBC, a lot of talk about these stocks, especially in January of this year. GameStop, AMC, up significantly. These are the stocks that got very popular in the Reddit forums where you had kind of retail investors, out buying options on these stocks at basically no cost to kind of help drive up the price of them. And ultimately, at one point, GameStop was the largest allocation within the Russell 2000, having gone from, essentially like almost a penny stock being pushed up so high. You see, it's actually still a top 10 position within the small cap market. But when you look at the large caps, again, one thing I just wanted to point out here, we've heard a lot from managers about how the large cap U.S. stock market has really become concentrated in a handful of names. In this quarter, that tended to upend performance in large cap growth. Names like Apple, Amazon, Tesla all started to underperform. You see Tesla now after being up 500% still for the last 12 months. And at one point during the first quarter of this year, Tesla was actually the world's largest automaker by miles and miles. So, it's been pretty remarkable. And now we're actually continuing to see a little bit of a reversal in this outperformance of growth. A lot of the questions have become, with these organic growth companies that may have earnings positioned well out into the future, if treasury rates are growing, again, from 50 basis points in 2020 to 170 basis points in 2021, as investment managers or investors are discounting those future cash flows back to today's dollars, it's reducing because that interest rate is increasing. So that has kind of led Wall Street all of a sudden to start questioning some of these extremely high valuations that had been really prevalent in the market. And again, that's kind of rewarding the value side of the investment landscape more so than the growth side. Internationally, I think the one thing I would just point out to you here is, anytime you do see interest rates rising, that will tend to draw in kind of foreign investors to the U.S. government bond market. We're still kind of the preeminent risk-free bond market out there. And as those investor dollars are drawn to the U.S., it certainly creates pressure on foreign currencies relative to the dollar. And so this quarter, you see that in local currency terms, the EFA, kind of call it the foreign S&P 500, was actually up about 7.6%. It actually outpaced the U.S. large cap market. But then when we translate those to dollars, you see that return falls by about 4% to 3.5%. Again, that's because the dollar appreciated. So those foreign currencies don't buy as many dollars in the translation. We saw the same type of thing within emerging markets, although that depreciation wasn't quite as significant during the quarter. And then the last page I wanted to just touch on with you was the bond market. So this is interesting. And this, an interesting thing to me on this is one of the significant changes that we've made over the last few years has been certainly reducing our equity allocation, but we also added what we would call the non-core fixed income. So PIMCO diversified income, which allocates to things like emerging market debt, high yield bonds, areas that we hadn't gotten a lot of exposure to other than maybe the BlackRock multi-asset income fund. And so this quarter, you see that while, investment grade bonds, really there was no place to hide as interest rates increased, high yield bonds with their shorter maturities, their higher coupon payments, were really actually able to offer a nice line of defense within the market. So high yield actually generated a small increase of 90 basis points, while the bond market generically in the U.S. was down about 3.5%. So again, took some equity risk off the table, further diversified our fixed income, and that actually positioned us a little bit better to play defense against this rising interest rate environment in the first quarter of 2021. Let me stop there and just see if there's any questions on the portfolio or just, excuse me, on the economy in the first quarter of 2021. Okay, so from there, I'm going to move, touch on page 10, and I'll come back to this with some more updated numbers through April towards the end of my comments. But really, you see that we ended the quarter, really in line with all of our allowable ranges within the portfolio. So didn't see any really compelling reasons to make any certainly dramatic changes during the quarter. We are going to look at addressing some potential rebalancing just to really kind of take some equity risk out of the portfolio as we enter the summer months, and also expect to see our infrastructure investment with IFM. We're expecting to see that capital call occur probably the second half of this year. So I think there's some things we can do to kind of set aside those dollars, kind of babysit them as we await that capital call. But if you move to page 13 here, really the line that I would focus on with you is the very bottom, the total retirement system. You see, we started this current fiscal year at 122.5 million. Inevitably, we've got net outflows from the system of roughly $1.25 million, fees and expenses of about $320,000. And then offsetting that is kind of what we would term the return on investment between your income and your appreciation. All told, that's right around kind of $15.5 million, bringing us to 136.4 million. And that figure has fortunately grown through the month of April, as we've seen. So off to a really good start here in the fiscal year. And that kind of shows up on page 14. You see for the quarter up 2.3%, fiscal year to date up 12.6%, and then seeing this nice outperformance over the longer term periods as well. One thing that may kind of raise some questions are, kind of 81st percentile in the most recent quarter. Did we do something wrong? What's going on there? Really what that is reflective of is the fact that we have brought down the equity allocation within the portfolio. If you remember, when we did our last experience study, we were trying to kind of say, okay, how can we prudently allocate the portfolio to not be kind of overly reliant on the equity market and then subject ourselves to the inevitable swings there. And so what we did was, work to bring down equities. We've increased fixed income a little bit with the addition of that non-core bond. Ultimately, we're going to add infrastructure. We've added to real estate. And so in a quarter like this, the systems that I've seen that were up in kind of that top quartile or top decile were all typically anywhere from 65 to 75% invested in equity. So that's really the main driver here. I really don't think it was anything that we necessarily got wrong. So that was the main driver, and that's why you see us a little bit below median here for the quarter. But as you look out over the longer term, you see that this 1 year number I think is really interesting. Up 41%, even as we were kind of de-risking the portfolio. So overall, really good results here. And importantly, we're now consistently seeing this outperformance net of fees relative to our policy index, which when we started working together, the footprint was a little bit different there. We had been underperforming. So I think some of the changes have certainly benefited us. Within domestic equity, what I would say is, fiscal year to date, we're kind of right at to slightly ahead of our policy. It's been a little bit mixed in terms of the relative performance for our managers. So Boston Partners had been a manager that we, frankly, had demonstrated some patience with. They had kind of been resolute in maintaining some of that cyclical exposure, the energy, financial services within their portfolio, along with a fairly meaningful tech weighting. And so this quarter, as we really kind of saw the cyclical rebound take hold, they were able to generate that nice outperformance. And then also add some good stock selection in the technology space. And so you see now kind of a manager that had been demonstrating some underperformance, we've really now seen them move kind of back in line to ahead of that benchmark, and importantly, since inception, well ahead. Clearbridge, though, is a manager that's kind of been a frustrating, persistent underperformer for us. You see for the quarter, lagging the benchmark, and then it really lagging across, all the way back to inception. Now, the worst problem for an institution to have is that your manager's only up 21% when the market's up 23% since you've hired them. But I think the thing that's been frustrating to me in looking at their performance pattern is just kind of this consistent quarter in, quarter out underperformance. And as of March 31, we had actually seen them underperform in the last 7 straight quarters. And as we'll see when we look at our compliance page, one of the things that will kind of generate a red flag for us is if we do see a manager underperforming 4 consecutive quarters. One great question that Jerry asked in our investment committee was, you're kind of spending a lot of time focusing in on this quarter, and ultimately I am going to recommend that the board places them on watch. And for me, the thing that's triggered that recommendation is the fact that you've seen them persistently underperform, but that was in this market that was really dominated by this small handful of large cap growth stocks. Now that we've seen the market start to broaden out a little bit and they're still underperforming, I think the prudent course of action for the system is to go ahead and place them on watch. My expectation is that, as the market continues to broaden, that's going to create a good tailwind for them and they're going to rectify the situation. But I do think that this persistent underperformance would leads to watch list status for them. And then our 2 small mid managers, Clarkston and Jackson Square, both generated a little bit of underperformance for the quarter. In Clarkston's case, I think it was largely just due to the fact that they didn't own anything in the energy space, which has really dominated the small cap market. Typically a runaway bull market is going to be painful for them because, again, very conservative in their positioning, very deep value in the way they evaluate companies, but then they're also going to use cash. And cash at roughly 10 or 11% of that portfolio is another big factor that's impacted, 1, the quarter, but 2, this 1-year period. Again, as we look out kind of over the entirety, mixing in the ups and the downs, you see they remain a first percentile performer for the portfolio. And then in Jackson Square's case, they'd really been this huge driver of gains for us over the last year. Underperformed a bit this quarter. I think a lot of it was really just due simply to profit taking within their portfolio. So they've maintained overweights in areas like technology and healthcare. And some of the stocks that had continued to do well for them just faced a little profit taking, a little pricing pressure during the quarter. So no concerns with Jackson Square on that interim underperformance. On page 15, when we look at international, by and large, you see the portfolio working together to generate this nice consistent outperformance. Not surprising in an environment like we saw, we've added Oakmark as our value piece. It took a little while, frankly, for value to add value within international. But this substantial change that we've seen kind of the last 2 quarters, you've really seen them generate this nice outperformance, while Invesco, which is our growth-oriented manager, has really been able to kind of keep up with the benchmark. Not surprising that you would see this drastic handoff growth to value. And in that environment, that really creates a bit of a headwind for Invesco, while Oakmark, with big ties to some energy, to metals and mining with Glencore, the world's largest mining company, and then some of their European financial services firms, not surprising to see them really kick in some outperformance. And then Wells Fargo continues to do a great job managing our emerging markets allocation. This quarter, where I would say that they gave up a little bit of ground, was in their overweight into the Latin American space. You saw a little bit of volatility in Latin America, a lot of that attributable to Brazil, where the president of Brazil removed Petrobras, the state oil company, removed their CEO kind of during the quarter for trying to push through some price gains. That caused a lot of volatility really across the Latin American space. Fixed income, as I mentioned, was really a place for our managers to try and play defense. When you look at Garcia and Richmond, both managers were essentially in line for the quarter and the fiscal year to date with their primary benchmark. In Garcia Hamilton's case, I think it was just the fact that they were a little bit further out on the yield curve in terms of some of their portfolio positioning, while Richmond was a little bit shorter duration and also, is not afraid to incorporate some structured product within their portfolio. So those 2 factors really distinguish the performance difference between Garcia and Richmond. as I was pointing out to the investment committee, it's interesting the way you have two managers who really approach the world very differently in terms of building their portfolios, but over 5 years are kind of right on top of each other, a basis point difference. So again, I still think these are two great managers. I would note that Richmond kind of notified us of some pending retirements later this year. Our analytical groups kind of evaluated that. They don't think it's going to have any negative impact on portfolio management or performance. So not recommending any action take place on Richmond. And then PIMCO Diversified, as I mentioned, this is a newer piece of the portfolio focused on areas like emerging market debt, high yield bonds. I would say the high yield really generated the majority of their performance for the quarter, while corporate bonds, emerging market debt faced a little bit of pricing pressure. As you see, since inception, the absolute number is not fantastic of 1.1% since we hired them in February. But again, remember that, roughly August to March, we faced pretty relentlessly rising interest rates in the U.S. So being able to generate that positive return, I think, has really been a good allocation there. And you kind of see that manifested in the fiscal year to date period here, where we actually made some money in PIMCO while our core managers have faced some small losses. And then lastly, on our alternatives page with Morgan Stanley and BlackRock, I would say with Morgan Stanley, what we're seeing here is just kind of a slow recovery in the real estate market. I would say appraisals in the core real estate space kind of bottomed out in the third quarter of last year. We've actually now seen 2 quarters, Q4 and Q1, where we're seeing positive appreciation across almost the entirety of their portfolio. Retail, as you might imagine, is still facing a little bit of pricing pressure. But what they've tried to do is slowly but surely ramp up industrials. They've also diversified into areas like life sciences, so like laboratory, office, and then even some self-storage facilities, which have actually helped generate some positive returns and really more than offset any of the pricing pressure in the retail space. I would say for the quarter, they were probably held back relative to their peers because Morgan Stanley is one of the more conservatively positioned core funds that we work with. I think leverage is only about 18% on that portfolio. That compares to some of their peers from anywhere from 25 to 35% leverage. That certainly helped them withstand those tougher quarters in Q2 and Q3. But as we're starting to see appreciation ramp back up, they're going to give up a little bit of ground just because that leverage is going to magnify the appreciation. And then lastly, with BlackRock, good solid quarter, up 2.1%. I think 2 things here really stood out. One, this fund's certainly benefiting from the rotation to value. Dividend paying common stocks are typically, a bigger component of the value benchmarks. So that's creating a bit of a tailwind for their performance. They'll also actively hedge their portfolio against rising interest rates. And so we actually saw that pay off for them as well this quarter. So again, now that we've kind of moved away from this kind of straight up growth driven environment, this creates a much more conducive environment for BlackRock to add some value with their broadly diversified portfolio. Certainly, they've got a significant component in high yield bonds. That's around 20% of the portfolio, along with bank loans, which typically are going to have a floating rate structure to them. So all told, what we're seeing right now should allow them to kind of continue eating into some of that underperformance that we've seen kind of since inception. So let me stop there and see if there's any questions on just the plan performance or manager performance in the quarter. Okay. So from there, let me take you, I just wanted to touch quickly on kind of our manager checklist as we ended the quarter. And what I would point out here, so a couple of underperforming notes, Boston Partners, they were slightly behind the benchmark and slightly below median on the 3-year. Again, I think the trajectory that they're on with their performance is going to alleviate that relative pressure pretty quickly. So no concerns there. ClearBridge, as I mentioned, I am going to recommend that the board place them on watch due to some of this persistent underperformance that we've seen. That's certainly impacted their 3 and 5-year periods, even though they were only hired in 2016. And then Invesco, again, I think because of this tough quarter that we saw for growth in general, we've seen them fall a little bit below median relative to that peer group. Maybe some more aggressive growth managers in that growth peer group have certainly put up a little bit better numbers kind of late last year. But no, nothing there that causes me any concern or prompts me to any action there. And then on the fixed income side, a little bit of underperformance from our managers, not necessarily versus the benchmark, but versus their peers over the 3 and the 5 year period. I think that's largely caused by some of the peers in that universe will be more active in taking on like below investment grade bond risk. These are both investment grade or better portfolios. We really have them in there to kind of offset any substantial market declines. So this is something that we would keep an eye on, but I really understand what's driving them below median in the peer group. And I think it's really that they're doing what we've hired them to do, as opposed to getting anything wrong relative to the peers. So no recommended action on Garcia or Richmond with any of these notes.
Okay. Are there any questions from the board members for John regarding the quarterly investment report or the manager's watch list or the any of the items he covered?
I do think that we need to make a motion. And if now's okay, I can go ahead and make a motion to accept John's recommendation to place ClearBridge on the watch list.
Okay, motion by Courtney. Is there a second?
I'll second that motion.
Okay. There's motion and second. Shayna, can you take a vote? A roll call of the vote, please.
Courtney Bechtel,
Aye.
Nathan Douglas,
Aye.
Matt Glaves,
Aye.
Ed Keenan,
Aye.
Jerry Romero,
Aye.
Rod Riles,
Aye.
Steph Wagner,
Aye.
Vice Chair Rodriguez. 7 board members are in favor of the motion and 0 are opposed.
Okay, motion carries. Next item on the agenda is the vendor risk assessment by Denham Group. This will be in closed session. The time is now.
Actually, Pilar, there was actually 2 things I under my section. I had April and then a rebalancing schedule, which I can cover quickly before
Sure.
you move to that
Go
closed
ahead.
session.
Go ahead.
Thanks. So just April, not a lot that I wanted to spend here other than just kind of sharing continued good news with the board. You see, we produced another 2.7% gain in the month of April. And then, you know, fiscal year to date, again, continue to be in a very good position. I think entering what will probably be, you know, a little bit more volatile summer period. So you see, we're at around 15.7% on the fiscal year to date. I think so far in May, you know, net, we're probably around flat to maybe slightly down. You know, honestly, the way things have gone kind of over the last 2 weeks, we could very easily end up strongly for the rest of the month. So, but overall, we've put ourselves in a very good position to kind of weather any of that kind of volatility that could come up. The one thing I wanted to point out, though, as we ended the month, you know, I did just want to kind of point out we were starting to edge up a little bit higher within domestic equity. We're a little bit underweight in this multi-asset investment allocation. And remember, multi-asset right now is carrying a 10% target because that does include the commitment of $5 million that we've made to IFN. We're just waiting on them to make that capital call. So with that in mind, I put together a draft rebalancing schedule here. And this really accomplishes 2 things. You know, first and foremost, I think it's a prudent thing as we enter the summer to pair our equity weighting back in line with its long-term target, which is currently set at 30% for U.S. equities. And so you would see here, in order to do that, we would pull roughly $3 million from Boston Partners, $1.5 million from ClearBridge. That would bring them in line with their 10% targets. With those dollars, we would actually invest $1 million into PIMCO Diversified Income. That would bring us, you know, right pretty much in line with its 10% target. And then we would put $3.5 million into the BlackRock Multi-Asset Income. That would allow us to essentially fully fund the BlackRock target. And then we would also have that $5 million set aside for IFM. And we would expect that capital call to occur hopefully in the 3rd quarter, potentially into the 4th quarter. But again, BlackRock is the holding point for that. And I think just kind of taking out some of the question or the volatility, that's naturally going to be associated with equities at this point makes sense. I've also included in here $1.5 million coming from our international portfolio. And this is really going to be used to supplement benefit payment needs from the fund as we go June, kind of July and August. I had touched base with Wayne and he had indicated that in June he was going to require roughly $1.5 million from the portfolio. So I think that we can go ahead and kind of move forward with this. Wells Capital is an easy raise. That money's that fund is housed at the Bank of Texas, so easy kind of instruction there. Invesco is a commingled fund which requires roughly 5 days notice to get money out. So we can kind of execute both of these early in June, and that way we've kind of got that money set aside with no issue. So that concludes my comments. I don't necessarily know. I mean, this is really all kind of moving within our existing targets. I don't necessarily know that this requires a board motion, but we did just want to kind of bring this up to the board, make sure there weren't any questions or concerns associated with this rebalance plan.
Okay. Thank you, John. Are there any questions for John regarding the rebalancing, the allocations? Okay, there being none, we'll move on to item number 5, which is the vendor risk assessment by the Denham Group. The time is now 9:37 a.m. and the system will go into closed session to discuss item number 5 on the agenda pursuant to Texas Government Code section 551-089. The system will discuss the vendor's risk assessments associated with the system's electronic information and technology systems. At the end of the closed session, the system will reconvene in open session in this same Zoom meeting. I'd like all system trustees to exit the Zoom meeting, and we will convene in the closed meeting via video conference. And have we sent that link out, Charlie?
Yes, the Denham sent a Zoom meeting request.
Okay, we'll give, I think, the rest of the board members a couple more minutes to get on.
Pilar, Courtney had to leave the meeting.
Okay, so then we've got everybody on that it's going to be on, and nobody's. Let me see.
I have a hard stop at 10 after. I have a client call at 10:15.
Are we missing anybody, Shayna?
That looks like everybody.
Okay. The time is now 10:03 a.m. and we're back on the record in open session to continue with agenda item number 5. No action was taken in closed session with respect to item 5, and unless anyone has any comments about the vendor risk assessment, we'll move on to item number 6. Does anybody have any questions? Okay, there being none. Item number 6 is the actuarial audit final report, discussion and possible action. And I think, Mark, you're going to make a presentation on this?
Good morning, board members. Scott, if you'll let me share my screen, I'll put the final actual audit report up.
Mark, you are co-host right now.
All right, thank you. That's not what I wanted to do. Let me try again. Let's see. Can you see it? I think I clicked wrong. Let me try over again, Scott. I'm sorry. There we go. I probably should go back and start with the cover letter. I'm very thankful for Shirley staying on top of Ryan Falls, because they sent their final report and said, this is our final report, no changes. But they didn't include the response that we had sent them. And so, let's see here. Go back one more. They did redo the cover letter to document the process, and they did attach a response. So just so you know that they're following the correct procedure in the government code. They did mention that they had presented it to the actuarial committee on April 13th and to the full board on the 15th, and that there's this item number 3 here. There's a response from the system to the preliminary report, and that's included with the final report as per the state law. So if y'all have any questions about the cover letter, I can answer those, and then we'll go to the response and sort of summarize the response for the board. Any questions about this cover letter? I will point out, I'm sorry, not even give you a chance for a question. I will point out that the very last paragraph is one of the things that we pointed out to you in the preliminary report. They said that GRS is pleased to report to the board, in our professional opinion, the August 31st, 2020 actual evaluation prepared by the retained actuary provides a fair and reasonable assessment of the financial position of TESRS. Any questions about this cover letter? Okay, then I will go to the very end of their report. They put the response from the system. We worked with Shirley. We drafted a response and then sent it to Shirley for her review, Shirley and Wayne, and they were fine. And then we discussed this with the actuarial committee, and so I think we're ready to present it to the full board. And the typical way that you write a response is to respond to their key findings, key recommendations. And so we did, you can see we highlighted their key finding and said the board is pleased that you believe the August 31st, 2020 valuation is reasonable. And then we addressed the recommendations that they made in their executive summary. And we acknowledged that a methodology that they had mentioned for demographic assumptions could possibly enhance the development of certain assumptions, and we'll certainly consider that next experience study. As far as the economic assumptions go, we I guess we stated that actuaries all have opinions, and the economic assumptions are just educated guesses. And while they didn't believe that our 3% underlying inflation assumption and the investment return assumption was reasonable, we think the key thing is the investment return assumption. And we believe that, well, we believe the 3% is reasonable. That's, I think, within our range of reasonableness. It's actually in the Social Security actuaries' range of reasonableness for a long-term 75-year projection. And so we acknowledge that it's not unusual for actuaries to have different opinions. And it's in effect, we were saying we agree to disagree. Professional judgment. But we do review the economic assumptions every 2 years as a part of the biennial evaluation. So we were saying we believe that that was reasonable when we set the assumptions for the August 31, 2020 valuation. But Rebecca always reminds me, well, but that doesn't mean that we're talking about the future. Things could change. So we do say that what we always do, that this is just, we continue to review economic assumptions as part of each actuarial evaluation. That wasn't a response to Gabriel or Smith. That's just what we do. We put that in our actuarial evaluation reports. Then they had some recommendations on actuarial methods, and we agreed with one of them that we should make that change. And we pointed out, Rebecca actually did some testing and made the changes in our software to do what they had recommended. And we found that it would have increased the number of required years of state contribution by less than 1 year. So it was a fine tuning kind of thing, but we agree it's appropriate. And then the one that they recommended about adjusting the calculation of the expected service for calculating the normal cost, we did test that as well, and found that would have also had a very small increasing effect of less than 1 year on an increase in required state contributions. We're not sure that that's what we'll end up doing, but we did want to test it. The other one that they recommend was to make some adjustments to the normal cost for people that would replace those that were assumed to terminate. We're less convinced that this is appropriate. We did do some study, and it also sort of triggered the idea that perhaps we should review the appropriateness of assuming middle of year termination of decrements instead of beginning of year decrements. So it's given us some food for thought. And so we say we'll consider this idea, and that's a standard way of responding to a recommendation that you're not doing it currently, and you're not convinced that it's a correction, that you're not sure what kind of enhancement or if it even is appropriate. So we will do some more testing. We've talked a little bit with Brandon Fuller too, just to get his pondering on that as well. And then they made some recommendations about adding things to the valuation report itself, and we agree that those things would enhance the report, and we will add those things. So that's the summary of our response. And when they got the response, they didn't change anything in their report. They left it exactly the same. So be glad to answer any questions you might have.
Okay. Are there any questions from the board members for Mark? If not, I'd like to entertain a motion to accept the actuarial audit final report.
So moved.
Jerry, I'll second. This is Jerry.
So there's a motion by Matt and a second by Jerry.
Yes.
Shayna, will you take a roll call vote?
Nathan Douglas,
Yes.
Matt Glaves,
Aye.
Ed Keenan,
Aye.
Jerry Romero,
Aye.
Rodney Riles,
Aye.
Stephanie Wagner,
Aye.
Vice Chair Rodriguez. 6 board members are in favor of the motion and 0 are opposed.
Okay, motion carries. Shirley, can you explain the submittal requirements for this accepted final report?
Yeah, it's pretty simple. We'll send a copy of the final report. This is required in the statute. Send it to the Pension Review Board, and we'll also post it on our website on the financial page. And that takes care of the requirements under the code.
All right, thank you for that explanation, Shirley. We'll move on to item number 7, actuarial service request for proposals. We need to appoint an evaluation committee. And at this time, I'd like to ask Rodney and Ed Keenan if you'll serve on that committee. And Rodney, I'd like you to chair it. And I'll be the third member that serves on that, if both of you will accept.
Yeah, that's fine.
Okay. All right. Thank you.
That's fine. Yep.
All right. Thank you. Item number 8, Executive Director's Report. Shirley?
Okay, I'm going to share my screen. Y'all let me know if can y'all see my screen?
Not yet.
Are we good?
We can see it now, Shirley.
Okay, I'm going to, I think I'm going to, let me see if I can. I know when okay. There's a few things that I want to cover, just to provide y'all with some information about some of the system administration and activity that's happened since about 4 weeks ago when we had our last regular meeting. We're also in the process of really closing out the annual report season, and there's some activity that we'll do with that. I wanted to provide a recruiting and technical assistance update, and then just a brief update on our training plan. As y'all know, the session will soon be over at the end of the month. I've talked with Chuck and Elisa with Jackson Walker, and they'll provide an update at the June meeting to give you a briefing about the legislation that's would be important for the system. We had a data event and that resulted in a process change. Some of this flows right along with some of the things you've been hearing from Denham, and I think it's a good change. I'm glad that we're making a change. We're going to continue to work remotely. We haven't heard anything from the governor's office with us going back to our office buildings. It's kind of trickling in from other agencies because of the nature of their business. But right now, we're still good with weekly office assignments. We have a benefit specialist position posted. There were over, I think there were 55 applicants last time I checked. And Cassandra and Shayna are reviewing those, and we'll do the first round of interviews. And come up with two or three or four finalists for a second round of interviews. Just to remind you, Cassandra is now in the position to be our HR representative. She'll do HR and purchasing, and then Shayna has moved into what was my old position with contract management and deputy director. But they're taking care of those first round of interviews. The event that occurred we have a DocuSign process to where we, through DocuSign, send a packet or send a document for a retiree to sign for us to, and then we all sign it, we get it back, and that can, then we're good to set them up for their first payment. In that packet, since it's been implemented, the last year or two, we've had everything that kind of represents the information that we gather in order to process a retirement. It also included a copy of the driver's license and the information about banking and direct deposit. And we've done this for, like I said, for a long time. We had an occurrence where if you're working on several at once, we had the name of the applicant, but we used another applicant's email address in DocuSign. So it went to one applicant's information, went to another applicant's email address. That applicant contacted us and said, "This isn't my information." We immediately contacted the person whose information had been forwarded to somebody else, and explained the problem. And we immediately went through the process to purchase identity theft protection for that individual. And I think Shayna worked with him on that, and she said that he was very pleased and impressed that we were going to that degree with regard to this event, to this problem. Now that immediately, it just immediately became apparent that we were sending an awful lot of information through DocuSign that we didn't need to be sending. They know what their driver's license looks like. We didn't need to send it back to them. So DocuSign, its purpose is to sign documents. So we're going to send what they have to sign. We also developed a checklist to go with it that shows that we have all of the pieces that we need in our possession in order to process the payment. So because when you're putting in an email address, whether it's DocuSign or just in an email, it's very easy to make a typo. And depending on the email address, a single letter in the email address can make a difference, and you're not going to know where the information is being sent. So I think that this was a good change, and the process has been documented, and it's a change that I'm glad that we made. It did reduce the risk, certainly, of sending sensitive information to a wrong email address. Wanted to give you, I'm going to try to do this every time we meet, and give you a snapshot of what's happening, with regards to our with toll with our system. We processed 17 applications. You can see that our average days to complete an application has improved, which is great. We've had a little bit of an uptick in active members from March to April. Just as we have with the number of payees from the applications that we're processing, and our total benefits paid also ticked up a little bit. But interestingly enough, and this is simple math, but our average benefit payment really didn't change. With regard to toll, and how these transactions, this event type, the information we can get from the system about when, the entry date, how many 502s did we process that had an entry date in January or February or March or April. Same thing with re-enter and terminations and transfers. So over time, as we receive forms for these event types, these numbers will change slightly from January, February, March, April. It's kind of like you refresh the numbers every time you go look. I think it's important for us to know this kind of information, because I think it helps me see where are we, how many net members are we gaining or losing. So it's a good indicator of some efforts on our part to work with departments to enter those members that have not been enrolled, and we've been doing a lot of that. Scott's been working with departments that have gone back and enrolled people that should have been enrolled and have gone back, 6 months, a year, 2 years. We've had, Cassandra and Tamika have worked with departments as well on that. But if you take a look, the entry, re-entry, and transfer, those are we're still getting contributions on those folks. Those that have terminated, we're not getting contributions anymore. And if you do the math on how many did we lose and how many did we keep, we're at a net of, we lost about 43, I think, members during this period. I don't know that we've watched this before. I think it's a good thing for us to watch, because I think it tells us a lot about our work with departments and our work with recruiting. So I'll keep that slide. I'll keep this slide going as we move through the rest of the fiscal year. With regard to annual reports, it's time to shut that down. Our annual reporting will close out in toll at the end of the month. So any reporting of qualified service for 2020, we'll have to use another process because we've got to close it out. We've had at the time I did this, I guess a day or two ago, we had 180 that had submitted the report. The 16 that have not submitted or that are pending. I'm thinking that there's going to be 4 or 5 departments out of that group that will get us an annual report before the end of the month. We've got a couple in that 16 that we need to have some conversations with them about. Are they, are we, about revoking, that they're in a state, in that state that it's time to have that discussion. And some other departments that have just had that, we always have to do an awful lot of technical assistance. Same group every year. But we will be continuing to work with them and to work with them on getting their qualified service in. The first week in June, we will notify that we now have information in total about chiefs and participating department heads, and we will notify the chiefs that we've closed it out, and that you're not going to be able to do your annual report in total anymore. And we'll also send to those departments that have not submitted an annual report by that first weekend, by the end of the month, the members will get a postcard. It's a generic postcard that tells them you did not get qualified service for the past calendar year, excuse me, because your local board failed to meet, and tells them to contact their local board chair. I think their local board chair or their chief. Part of this all dovetails into our producing benefit statements and mailing benefit statements out before the end of the fiscal year. I'm hopeful that we'll be able to do that. Part of this work will also include working with Indus Moksham on getting those benefit statements out through toll. And obviously, if we don't have annual report information for 2020, those for some of those members, those from those few departments, they'll not have their 2020 information on their statement. That's one reason why we want to notify them up front that the report wasn't submitted. Recruiting, Scott's had some recent interest, some notification about some departments that I think are promising. They're at the bottom of the list. Sam Bass is in Round Rock. Valente is out in western part of Travis County, and then the Orange Fire Department down around Beaumont. Henrietta's very interested, I think, and Jasper has the departments in Jasper County. I think there's several departments that they're interested in bringing in. Obviously, some of these are more promising than others, but I think that here in hopefully in the next couple of months, we'll have some new departments from this list. With regard to recruiting, SFF in May and June in Lubbock, I think it's an abbreviated meeting. We'll probably not attend. I think that Scott talked with Matt about looking at some of the regional meetings and attending those. And I think that's a good idea. We'll need to look for some of those meetings that we can get to. In July is TEEX at College Station. We'll be there, and at Safety in Fort Worth. Both of those have always been really good conferences for us, and it's not only a good chance to get to see some of our participating departments. We also do some recruiting there as well. In November, the Texas Fire Marshals Association is in San Marcos, which is just right down the road. While in the large part, a lot of the fire marshals aren't. It's not exactly the audience that we would need, but in some smaller communities, and with volunteer departments or combo departments, I think that there might be some opportunities there, and it's close by. With regard to training, I'd asked Scott, so the things that were the modules that we're kind of looking at getting some short clips together. And I did Shana had brought up us looking at Adobe Spark. There's an online version that's free. I think there's a better version that's relatively cheap. And I don't know if you're not familiar with it, it will have a little background music. You can add photos. There's stock photos, Adobe photos you can pick from. Played around with it yesterday, and it's really not bad. And I think that that would be something we need to try, something we need to think about, because I think it would be a really good, especially for our website, for something general. I think that, I think it could work. I think it could be a good tool for us. And I'd like to have something, we need to produce, get a product, get it out there, get it on our website, and have something ready for June that we can offer either for chiefs or for just general interest in joining the system. Either like looking at your MRR, I'd like to have something out there June and July, so we could point to our website for that kind of training. That concludes my presentation. Are
there any questions for Shirley from the board members?
Jerry, I have a couple.
Go ahead, Jerry.
Yeah, so first and foremost, on the DocuSign issue, we just went through this whole cyber trading and so forth, and I'm not sure what the process is, but having identified this as an issue, I know you made some changes. But is there a two-step process where maybe two people are looking at this to ensure that the information that's being sent out is appropriate, it's being sent out to the right person internally?
Yes, the process has always been whenever the DocuSign is sent to the applicant for signature, when it and when you set up the DocuSign, there's a sequence of signatories, and it will go to the member first, and it'll come back around through a process. To Wayne and to me and then back to the benefit specialist. And so we're able to review the document, the entire envelope upload that was sent to the member. And now we have their service retirement certification document, and we have the checklist. The other thing that happens before we ever get to DocuSign, we use a database that I think it's it's a really good tool. It was a template that we found online, and we can upload documents to that template. We assign it. It comes to me. I assign it to the benefits specialist. I look at the documents that have been uploaded there to be sure they're complete. Ellie receives the application for completeness. She'll be sure we've gotten their driver's license, so we have a confirmation as to be sure who they are, and she also prepares the checklist and puts that together. She prepares the TENS number. So there's a flow through Ellie and benefit specialist and me and Wayne. In the approval process for a benefit.
I hadn't thought that you all are putting the package together. I guess my question really is about once the package is prepared and ready to be sent out to the member, prior to it being sent out, is it just one person that reviews the documentation before it gets sent out? Or does the second person look at it to ensure that the email and everything else is correct and it's the correct member? That was my question.
Cassandra, I don't know, you might be the best person to answer that now and our current process.
So our process now is when a benefit specialist makes the envelope and is ready to go out, the second benefit specialist will look it over to make sure that it has the correct email address, the correct chairman that it's going to for that department, and it has all of the applicants' correct benefit amount, as well as his contact information. So yes, we have two benefit specialists that checks it before it goes out, and then once it's ready to be sent to the member, it's done at the same time after the second review.
Perfect. My second question is on your recruiting of the interested departments. Is there any way that you can add some additional information on these different departments, whether they've been contacted, your pending information, something to just give us an idea of where you are in the process?
Yes, and my apologies to Scott because he provided that information. It was. He could probably, Scott, if you want to, you could probably give him a little bit better briefing about the promising departments that you're in touch with.
Sure. Yeah. Henrietta, I spoke to Henrietta yesterday, and they're meeting with the city, I believe, on the 25th. The department's actually meeting with the city, so it's gotten to that point. Jasper, they took the information to the ESD board. So we've made it past the first step there. They took that back in April. So it's time to do a little follow up. Don't want to bug them too much, but just want to keep the traction going on that. And then West Orange talked to lady Marita Kennedy, and she's a mayor pro tem and also city councilwoman. And she was taking that information to the chief, hopefully tomorrow afternoon, to see if the chief's interested in it. And the great thing about that is we already got the city council behind us and also the mayor's group. So that's three that's really promising there. And then Shirley mentioned Sam Bass and Valente. We recently signed up Williamson County as a new department back in February, I believe, and they jumped all over this. They're a big fan of the pension system, and the chief out there, excuse me, Brad Landy, met with him last week, and he wants to introduce me to the Sam Bass and Valente individuals. Now, they're paid and part paid, and so that's what we ran into signing up the Wilco group. And the Wilco group, initially they were the Jollyville Fire Department here in Austin. And they had to dissolve, they didn't dissolve that, but everybody became an employee of the ESD, all the paid members, and then they left the volunteers in the Jollyville Fire Department. So that was our first introduction to signing up a paid department. I'm not sure if the Sam Bass and Valente group's going to be the same way, but I do know that they're very interested and they want to start having face-to-face meetings. We started with Jollyville, Williamson County back in July, and it took us till February to sign them up. And so that seems to be, you know, once we start getting this traction going with these departments, I've been here a year and a half, and within the last 3 months, we've signed up 2 departments. It takes a while, but the kicker is we got 3 of them that are really interested, and hopefully these other 2, once we meet face to face with them, they'll be on board.
Thanks, Scott. And it's really, I don't need to have a report every time we talk about this, but in the presentation, if you could just add, you know, a pending comment or a first contact was made or waiting for approval from the city council, something along the lines gives us an idea of where you are in the process of trying to get them signed up.
We'll do it.
Appreciate it.
Sure will.
Okay, are there any further questions for Shirley and the staff? If not, we'll move on to agenda item number 9, future agenda items and meeting dates. The next regular board meeting will be Thursday, June 17th at 9 a.m. And a couple items that we have on that agenda is the legislative update and the quarterly expenditure report. Anything else to add, Shirley, for the future agenda?
I'm sure there will be, but I will take stock of all that here really soon and start putting the list together.
Okay. All right. Thank you. If not, can we get a motion to adjourn?
I'll make a motion to adjourn this, Jerry.
Okay. Motion by Jerry. Is there a second?
I'll second it.
Okay. All those in favor signify by aye or raise your right hand.
Aye.
Aye.
Motion carries. Meeting is adjourned at 10:41 a.m.
Thank you.
Y'all have a great weekend.